So we're going to continue our read with me episode 4 with our chapter 4. I guess we just be taking it chapter by chapter per episode then. But yesterday's episode was so long, over 2 hours, and we tried to read through. So maybe I'm going to reduce my commentary and just stick with the book and try to read through as fast as we can, so that at least. But at the same time, in the process of you listening to the something you can just uh, you can just increase the speed. Even if you put it at two times, two times speed is still going to be more fast. So, and you're still going to it's going to be very, very clear because I take my time and patiently read it out, so that at least, so if you put it at 2x, then you'll be able to kind of like, so I don't want to be in the position of reading and not personally understanding what I'm reading out. So I want to learn from it, and at the same time you too should be able to learn from it. So without wasting time, let's just go straight into it. So in this chapter, chapter 4, uh we'll be learning formulating profit objectives, using risk reward ratio, using saying that greed is another word for fear, dealing with drawdowns and managing positions. So these are the things we're going to be tackling in this chapter. So chapter 4, it is implementing your trading plans. Implementing your trading plans. But some things are hitting me here. And last episode we talked about processes. Processes. So talking about processes, then we kind of like, okay, uh, the process that we're going to go through and other stuff. So formulating profit objectives, using risk reward ratios, seeing that greed is another word for fear. So I'm trying to get get that into my system. Fear, greed is another word for fear. Like, that is greed another word for fear? Okay, yes, I kind of think I kind of understand now. Because why are you greedy if you believe in abundance? And you will always have. So it is fear of lack that makes us to be greedy because we don't want to lack, we don't want to go. So okay, I guess that now. So implementing your trading plans. So chapter 4 is implementing your trading plans. So I'm sure first paragraph, I'm sure you've often heard that in trading. Add that in trading, you limit your losses and let your profits run. Okay. Uh, Personally, yeah, I have what is it called with that? So I'm sure you've often heard in trading that in trading you limit your losses and you let your profits run. One fundamental rule of trading sounds like this. If you focus on consistent loss limitation, the profits will come by themselves. This statement is correct as empirical studies demonstrate. Okay. If you focus on consistent loss limitation, the profits will come by themselves. Okay. This statement is correct, as empirical studies demonstrate. In Germany, for example, 80 to 90% of the surveyed portfolios of private investors shows a negative performance because their losses repeatedly get out of hand. Okay. In other words, losses are realized too late, and the profit gain are insufficient to compensate for the losses incurred. Traders tend to take out profit too early. Remember, it isn't enough to chalk up to 60 to 70% average of winning trades if you don't run up profit and your losses are significantly higher than the profits. Your average profits and losses depend on the selected position sizes and the market fluctuations. Yes. So the management of your portfolio risk should consider the answer to these two questions. Okay. The management of your portfolio risk should consider the answers to these two questions. What daily fluctuations are you willing to tolerate? Have you adapted your position to reflect market volatility? So the way me personally do my own is I use risk reward ratio. So regardless of, even if I'm using 50 pips stop loss, I still kind of like that means I'll be targeting 150 because my own something is I believe personally from my own trading system that wherever point of entry I'm taking should replicate itself in five places. So if I'm targeting 1 to 3 to 1 to 5, then automatically I know that that will cover up my something. So let's just keep on reading. So combining good money management skills with good risk management, with good risk, combining good money management skills with good risk management skills helps you to keep a firm grip on your overall risk exposure and the total return of your portfolio. Okay, so let's try and understand that money management skills with good risk management skills. Okay, if you manage your money very well and you control your risk, then it will help you to keep a firm grip on your overall risk exposure and the total return of your portfolio. Okay. So, tip for us here. For a solid overview of the important subject of money and risk management, I highly recommend LITAF. Money and risk management. I highly recommend LITAF and Grayson Trading for Dummies, fourth edition. Okay. Some traders confuse large market fluctuations with profit opportunities. They increase their position with increasing market volatility, hoping for fat profits. That strategy can easily go wrong because portfolio fluctuations tend to increase drastically in such conditions. So you will be under severe psychological pressure to act and act quickly. Greed is a bad counselor and sometimes leads to overconfidence. Risk management with foresight means that you adapt your position sizes to current market fluctuations in order to protect your portfolio. If your trades are too large in relation to your portfolio, the portfolio fluctuation can reach dangerous proportions. Follow a simple rule. If the volatility of the market increases, reduce your stakes. The aim is to control the impact of the loss period on the overall portfolio. What risk are you willing to take? Where is the pricing threshold for your portfolio? Your risk tolerance determines your portfolio risk and thus the position sizes you trade. Okay. So managing your opportunities intelligently. The opportunities we have in the market, managing it intelligently. No one will argue that the focus in trading should not be on the consistent use of stop loss or orders for loss limitations. Would argue, no one would argue that the focus in trading should not be on the consistent use of stop loss orders for loss limitation. Yet, that is merely necessary, but but by no means sufficient condition for successful trading. Okay, let's see what it means by that. Remember, if you want to be profitable in the long term, you need to make bigger winning trades. Okay, as the trading psychologist Brett Steinberger rightly points out, the problem many traders face comes from how they deal with existing opportunities, not from how they deal with risk of loss. Risk of loss. If you have no clear profit goal in mind, it is difficult to become profitable. In chapter two, I talked about how process goals are more important than profit goals. Because designing your trading processes means you have everything under control, though you can never hope to have any real control when it comes to achieving your profit goals. The market are the only factor that determines things like profits. Don't draw any wrong conclusion from what I say here. However, establishing frictionless processes certainly takes priority. But this includes establishing a consistent loss limit. At the end of the day, you still want to earn money from your trading. In other words, despite the fact that much is out of your control, you should think very specifically about the profits you want to achieve. Ask yourself the following question. So before we ask ourselves that question, personally, I just want to ship in my own thoughts because as I'm reading, I'll be comparing it with what I have in mind before. Too. So the way I do my own stop losses. If you've been following my trade ideas and signal, you will understand it that it is market that determines the levels that we're going to put our stop loss. Uh, and the level we put our stop loss is the level of invalidation of our trade, where we know that if price should get to this point, then our trade is invalidated. That's the level I do put my stop losses. So once my stop losses got tapped, then I know the trade I was in has been invalidated. So I can no longer rely on that trade again. So that's how I set my stop loss and the return for my stop loss. So all these things are useful, but at the same time, I believe personally that it's your strategy that determines where you put your stop losses and your something. But we are studying psychology because many people, when they are trading plan, give they usually don't follow their trading plan to the smallest rules of it. Like I said now, a lot of people we might put a stop loss where market is going to be validating something. If you over risk, your account might not be able to sustain it to that point. And if you see any minus something, any negative something or negative balance on your account, you might quickly want to close out this something. You are taking a loss, but at the same time, you're not giving yourself enough room. So we basically calculate our position sizing from whatever our strategy indicates, and you don't stick to one position sizing. It is my stop loss that will determine what I'm going to. So basically, if I'm trading a 5 pip stop loss, then automatically I'm going to be using the exact amount I'll be using on 50 pip stop loss. So that's it. So every trade are the same. So the level of invalidation for each trade are just different. So one will be faster, but it doesn't still mean that the 50 pips own will not yield the result at the end of the day. So stick to your plans. That's one thing. And if your something indicates one thing, don't do another thing. Thank you. Let's continue. So let's ask ourselves uh the following question. What is your absolute take profit target for each trade? What is the time frame, hourly, daily, weekly for achieving your profits target? How do you define the risk reward ratio for each of your trades? What rate of return do you want to achieve with your trading account weekly, monthly, and or annually? Set your focus on achieving realistic profits and plan this to the letter in advance. Part of your plan should include I only target 20% anyway of my account, let's say monthly. So that's that about that. So finding out how high opportunities and risk are before opening a position. Playing through all possible scenarios in your mind beforehand, knowing exactly what you will do if you are racking up profits or if the market is against you. So remember, experience shows that most traders pay a lot of attention to finding the right entry point. Perfect timing really works in the reward, and it should not be your goal either. Pay attention to managing your trades from entry to exit rather than finding the perfect sweet spot. If you find it tip, if you find it difficult to take the plunge and enter the market, start with a partial opening. Once you are in the market, you will find it easier to actively manage the position and expand it if necessary. Brain research states that even the smallest activity work to break up mental blockages. So you can do that because, well, to me, if once you've established your risk and divide it up, turn it to probability game, numbers game, then I should believe you shouldn't be having any difficulty. The thing is, if you're having difficulty trading, then you need to go and learn position sizing and know how to calculate the amount that you're going to be putting on each trade. So you don't need to be disturbing yourself and with what is it called? So and if you are still scared, then definitely you are risking too much. You are risking too much. So the entry is only the first part of the practical implementation of a trading setup. Stop loss limits, position size, holding period, and establishing a realistic profit goal are further components. The next section deals with the correct ratio of profit opportunities to loss. So balancing another subtopic, balancing opportunities and risk reward ratios. The risk reward ratio, also known as RR ratio, is the central control instrument in trading, honestly speaking. It is one of the fundamental principles when it comes to managing money as well as risk. The RR ratio sets out the potential losses for each individual trade in proportion to the potential gains. In this way, you can measure an investment potential performance. You can set you can get a feel for the risk you are taking in order to reach a specific profit goals. Like I've usually say, risk reward ratio is the backbone, and that's the best way to convert your trading to betting, and at the same time be able to convert it to probability game and numbers game. So that would be something. So let's continue. Say you purchase a share at the current price of $10. You secure the position with a stop loss at $9. You take profits. Your take profit limit for closing the position is $12. Your position risk is the difference. Your loss risk is the difference between the purchase price and the stop loss. Your potential profit is the difference between the purchase price and the target price. Then you divide the potential profit by the potential loss. And in this simplified case, the RR ratio is 2 to 1. So remember, the RR ratio says nothing about the probability of your trade being successful. Instead, it shows you what profit you can expect when you risk $1, assuming that you achieve the profit goal. Empirically, analysis show that you should seek an average RR of 2 to 1 per trade in order to be successful in the long term. That sounds obvious because the larger the RR ratio, the more loss trade you can cope with. Therefore, an estimated success rate of 50% means profitability for you. As sobering as this statement sounds, a few traders manage to continuously close more than half their trades with a profit. That's why controlling profitability with a sufficiently high RR ratio is important. And that's true. The lowest RR you should be aiming for is 1 to 2. But with my own trading strategy, I aim for 1 to 5. I've reduced it because of the waiting period. Sometimes takes time before we reach that 1 to 5. But obviously, eventually, price do reach that 1 to 5. So I just decided to pick 1 to 3 so that at least we not have any mental blockage for another trade. However, some traders make it too easy for themselves. You must consider the relationship between your hit rate, the percentage of your position that have actually reached the profit targets, and your RR ratio. The higher the RR ratio, the lower the hit rates. That means if you set an unrealistic high profit goals, unrealistic profit goal, the profitability of achieving it is comparatively low. With a RR ratio of 10 to 1, for example, the question naturally arises of whether it's possible to ever achieve this profit goal. In short, the larger the RR ratio, the less likely it is that you will achieve such ambitious goal. Remember, never daydream. Price targets should be realistic and not influenced by your pipe dreams of euphoric. Be aware that Be aware, most of my trades that I do it stop losses. They don't even 1 to 1, they don't do it because the way I pick my trades is very, very precise. So most times we'll be wrong, but at the same time, once we are in the right something, then we know and we believe that it's going to yield right for us. So be aware that trading only deals with probabilities determined by the markets. You should keep that statement in mind when you are calculating your profit opportunities. It seems that for certain traders, the temptation to cheat themselves is just too strong. Errors in reasoning, as illustrated in the following list, sneak in involuntarily. Such traders plan a trade and increase their profit target higher until they get a better RR ratio, even though the probability of reaching that price target is quite low. Such traders drag the stop loss limit closer to the purchase price in order to make the RR ratio appear more attractive. Here, the danger comes from being stopped out prematurely. To compensate for a trading loss, they increase the price targets for the next trade. In this case, you are fighting the market, indulging in what is known as revenge trading. You want to recoup lost money. In all three cases, you are ignoring the market mechanisms. You are no longer following the market. You've devoted yourself to the unnecessary manipulation of RR ratio. Calculating the RR ratio is a subjective manner. In a subjective manner, it's obviously a weakness and a counterproductive use of this particular control mechanism. The dilemma is simple and poignant. Although a high RR ratio has a positive impact on expected profitability, it nevertheless leads to a lower probability that your price targets will be achieved. Remember, your trading style always influence your risk reward ratio. A scalper who trades on very short time frames, your trading style always influence your risk reward ratio. A scalper who trades on very short time frames with low position sizes may choose a significantly lower RR than a swing trader who may keep position over several days or weeks. If you have if you have extensively tested and trailed your trading strategy, you will usually be good at predicting what RR is realistic for your trades. Yes. By paying attention to the price movements, you can calculate the required hit rate, a RR ratio that's appropriate to the market. This is the way to compensate the advantages of a high RR ratio with the disadvantages of lower probability. Remember, you need to plan a realistic RR ratio for every trade you make according to the market environment and what suits your trading strategy. Successful traders are the ones who enter position with low risk and relatively high profit opportunities. Looking at the calculation methods, if you are mathematically gifted trader, you have two formulas for exactly calculating the required hit rate or RR ratio. To determine the lowest possible hit ratio needed in order to achieve the desired profit threshold, the break-even point, in other words, use the following calculations. Hit rate equals to 1 divided by 1 plus RR ratio. Like I used to say, if you are using 1 to 2, just add it up. That's 3. That's 3 for you. But you've calculated your risk. So in 10, you just calculate it in 10. How many do you have to win? So you assume that all the 10 are lost in the market and you are able to win only 4. If you win 4, then 1 to 2 ratio, ratio 1 to 2 RR is something like you turn it to 3, then you plus the 1 plus 2, then 1 plus 2 equals to 3 times 4 that you win out of the 10. Then that would be 3 times 4, that's 12. So that means you have 20% gain on your 10 trades. So the RR ratio you need for a given hit rate is calculated this below. So RR ratio equals to 1 divided by hit rate minus 1. So say you have an RR ratio of 2 to 1 in case as a 33% hit ratio would, in this case, a 33% hit ratio would reach the profit threshold. So that means that at least every third trade would have to reach your take profit target. So resisting the evolutionary urge to cash in our evolutionary heritage weighs heavy on us humans. Allowing your profits to run up requires enormous self-discipline because you have to act against your nature. Your trader cycle will always find creative excuses for why you need to quickly close a position that is making a profit. Maybe you tell yourself the following: many pennies make $1. No one has ever died from taking out their profits. Greed is a bad advice or technical stuff from an evolutionary standpoint of view. We humans have a natural reflex to realize profits quickly without even thinking about it. Your brain will automatically fall back to trusted behavioral mechanisms. This desire for immediate reward, instant gratification, in other words, is controlled by this desire for immediate reward is controlled by the release of neural messenger substances, dopamine, also colloquially known as the happiness hormone. So, recognizing that fear is a bad advice, greed, and fear. So, the list of excuses you can come up with for taking early profits goes on and on, but it shows one thing above all: the person is mortally afraid of losing the profits they have made. A fear based on the pain they will suffer if they, after making a profit, manage to later lose the unrealizable profits. Unrealized profits. The problem is the lack of confidence in your own choice. Your whole attention span is absorbed by the development of this one position. You are suffering from tunnel vision and can only focus on how much money you could win or lose with this single trade. You involuntarily interpret every price movement as a potential danger or threat. You are caught up in your emotions and have lost sight of what is happening in the market. So your trading shouldn't be based on one single trade. We are playing a probability game, a numbers game for that matter. So if you stick to one and you are beating yourself up just because of one trade, then you are here to know what you're doing. From a psychological point of view, you are not really worried about a single trade, rather it is your ego that's identified with these concerns that throws your emotional balance off kilter. Tip: if you feel emotionally off balance, leave the room, take a deep breath, and make sure to use physical movement to relieve your emotional tension. This strategy allows you to bring a plan trade to an end as planned and in accordance with your rules. Another subtopic: gaining emotional distance. I'm asking you to keep in mind these three principles, which will probably help you act objectively and with emotional distance. Define a profit goal for each trade beforehand. React only to market changes, not to individual positions. Concentrate on the profitability of the entire portfolio in any given period, not on individual trades, like I've said in the past. As long as you maintain the perspective of a neutral observer, you are in a position to control your subjective concerns about the outcome of individual trades. Clear price targets will help you keep a cool head whenever you feel that you are starting to think about the profits or losses of an individual trade. Distance yourself and take a break. Use the break to think about what triggered your loss of concentration or distracted you from what was happening on the market. Ask yourself these questions. Was it the fear that you cannot endure individual losses? Was it a sense of excitement at the prospect of making possible high profits? Was it the fear of later losing your book profits? The triggers vary depending on the situation and the general mood. In addition, every trader reacts differently depending on their personality. You must learn to recognize such triggers at an early stage. After you recognize them, ask yourself these questions. Are there recurring patterns? Can observe. How does my ego react to particular triggers? If you can find the answers to these questions, you will find it easier to stick with the three principles I mentioned at the beginning of this section. I admit that it isn't possible. I admit that it is not easy to keep calm when profits increase under significant fluctuations. Experienced traders Know that only those who have the most trust in their own strategy can endure the uncertainty about the outcome of a trade. If it often seems as though you need more self-confidence in order to stay with a trade that is making profits than with a trade that is running sideways or even at a loss. The reason is obvious. Sometimes high book profits are at risk. Tip in chapter 6, I talk about some mental self-coaching techniques that will help you to remain both calm and confident. I recommend checking out that discussion. You can spare your nerves by trailing the stop loss to your purchase position or even into the profit region. This enables you to render the position risk-free. Although such an assurance will bring with it smaller book profits under certain circumstances. Be sure not to place the stop too narrowly and get picked off on the next counter movement. Alternatively, you can realize partial profits. All these suggestions, there is no way it's going to work. And let's be sincere with ourselves. Your strategy should determine where your stop loss is should be, and based on your mode of entry, determine whatever if you are entering a trade. Always know that okay, this pair that I'm trading, this instrument, this commodity, this crypto that I'm trading, always yield whenever I enter this trade. Your strategy should be able to tell you the risk reward ratio that you should be expecting from your trades. Because if not, psychologically monitoring or something, you will make errors because market fluctuations is not constant. Today it might be slow, tomorrow it might be big. And if you manage your risk reward ratio very well, you're going to get appropriate something, because if you are using a 10 pip stop loss, you will know how to calculate the exact money you're going to put on that same trade. Which, if you know, our profit objective, I mean, is just 20%. And if you are using 1 to 2, you automatically need to win 40% of your trade. There is the strategy you are using for 1 to 2%. It doesn't matter how massive price movement goes. It doesn't matter. What you need is your risk reward ratio to calculate your numbers game. That's all. Because all these suggestions, follow this, follow that, you are giving yourself enough work. Let your strategy determine where to put your stop loss and something. But that's how he wrote his book, and based on his own level of understanding. So, but as far as I'm concerned with the way we are trading always, we know the level of invalidation. This is a level of invalidation. The amount I'm putting on the 50 pip stop loss is the same amount I'm putting on the 3 pip stop loss. Because if my 3 pips gives me 9 pips in return, which my 1 to 3, then automatically I've made my I've made my money back as fast as possible because it is determined by my entry. So that smaller entry can quickly yield, and that 50 entry to can still yield eventually. So it doesn't mean. So that is that about that in the market. I'll just place this one. So alternatively, you can realize partial profits and let the remaining position continue to run according to plan. This gives you a feeling of freedom of action and reduces your fear of completely losing book profits. At the same time, you find out that it can be worthwhile to allow profit to run to the target price. In effect, you hit three birds with one stone. Tip: the practice of meditation is an excellent exercise for observing thoughts without judging or identifying with them. Thoughts come and go, but you remain relaxed in the observer role. You will find that meditation makes it easier to tolerate uncertainty, keeping greed in check. And old German proverb states unequivocally that greed rots the brain. It's meant to describe what happens when someone's intellect is overrated and greed takes over. On the other hand, you have the fictional Gordon Gekko's famous dictum, "Greed is good," as expressed in the Hollywood film Wall Street. Which point of view is correct here? Before answering that question, let's start with a simple definition. Greed describes the excessive desire to want more and more. More possessions, more money, more success, more fame. So is greed bad? As the German proverb insists, if you were to answer from a purely biological evolutionary point of view, you have to say, no. After all, without the strong drive to find more food and reproduce, humanity would not have survived. Here are some other benefits of greed. Greed helps people to overcome obstacles and fears. Greed increases the willingness to take risks and provide unexpected powers. Greed makes people curious and increases their thirst for knowledge as well as their willingness to learn. So that means we just have to manage our greed. However, times have changed. People are no longer living in the stone age. Many money and the stock market are products of the modern era. The truth is that the human brain has its origin in much different time. It wasn't made for rational investment and certainly not for short-term trading. Remember, you say money isn't everything. Well, neuroscientifically, neuroscientific studies show that any monetary gain someone obtains without having to work 9 to 5 jobs for it brings with it significantly more happiness women than money they might earn from a paycheck. Maybe that's why traders are prone to emotional outbursts. So beside besides fear, greed is one of the two most dangerous emotions in trading. In fact, you can think of greed as just another form of fear. The fear of not getting enough. When combined with an inflated ego, greed and fear can turn trading into a vicious circle. Okay, the figure 4-1, trading's vicious circle. So it starts from fear, ego to greed. Okay, you know how important it is to that's the circle anyway, from fear to ego to greed, back to fear. So that's the vicious, that's what the diagram, I mean, the figure describes. You know how important it is to take advantage of existing profit opportunity. If you are unable to regularly realize greater profits, you will never be a profitable trader for the simple reason that you will suffer frequent losses. No matter what you do, even the best traders out there rarely have more than 60% win interest. Remember, the natural and the deep-seated reflex of quickly take out profit is difficult to control. That's why clearly that's why clearly defined profit targets for each trade and emotional distance are important. So, how and when does greed come into play? How about with overwhelmingly forces and all the time? That's certainly more than you want when trading. As for the consequences of greed, this list gives you more some answers. Greed drives you to continue what you are doing, even if you have suffered a losing streak. Greed drives you back to the market after a crash. Greed can sometimes make you forget your rules and take disproportionately large risk over leveraging in other words. So greed makes you resort to gambling and risky speculations. Greed leads to overconfidence and loss of control. Greed leads to over trading or revenge trading. Greed keeps you from learning from your errors. Greed is responsible for market excesses and speculative purpose. So neuroscientific studies show confirm that greed rots by effectively switching it off. Okay. Excuse me. So neuroscientific studies confirm that greed rots your brain by effectively switching it off. At the same time, some part of your brain must still be available to you in order for greed to function. This offender sits in the emotional center of the brain, functioning as the core of the limbic nervous system. It is the nucleus accumbens, which, when overactivated, ramps down access to your intellect. When the nucleus accumbens comes to play, you don't stand a chance. Technical stuff. The nucleus accumbens NAC plays a central role in the limbic reward system and is responsible for the development of addiction. Dopamine receptor in the NAC respond immediately when dopamine, the happiness messenger, is turned on to the system. The NAC looks to repeat that pleasurable modulation, reinforcing the already strong human desire for reward and pleasure. Sexual desire, gambling addiction, drug addiction, and mobile phone addiction are controlled by dopamine. The dopamine output sends a signal to the body and the mind, demanding that the desire be satisfied. Okay. Greed triggers motivation to move towards something. The deep-seated desire for profit is superimposed on your fear of loss. The determining factor is the prospect of profits, the expectation of profit increase, not the actual profits. It is this expectation of a reward that triggers neural fireworks in your brain and releases dopamine. This expectation anticipates the profits and reacts physically and mentally as though the profits have already occurred. That may tempt you into ignoring the risk and your hungers. You react according to the motive. Anticipation is half the fun and enjoying the dopamine. It's warning, following the rules when trading is burning for your brain. Subliminally, you are looking for the risk and the adrenaline rush. Dopamine is addictive. The brain is hungry for reward. The human reacts to expected profits as it does to drugs sales. The neural and biochemical processes in the brain are identical when it comes to any of these desires. When the profits actually occurs, the dopamine output returns to normal and the rational part of the brain are reactivated. It returns to normal and the rational part of the brain are reactivated. Disillusionment returns. As soon as a trade enters the profit region, the fear of loss takes over. This fear encourages risk-averse traders to realize smaller profits rather than let them go. It is a to and fro action between greed and fear. Imagine that you have realized a few smaller winning trades. You think this must be your lucky day. It is happening. This may be when you get cocky. Your happiness about the profit you've made is buried under the prospect of further higher profits. Your knack is activated and the release of dopamine leads to an increased willingness to take risk. You increase the size of your position and leave out the stop loss limit for now. After all, you expect a winning trade. The prospect of additional wins makes you forget how hard you lose. The stronger your expectation of reward, the stronger the activity in the night. Your intellect is powerless against these forces, and afterward, you have no idea how it happened. How could you have lost control? It is quite simple. Your thinking apparatus was in a waking coma. When your neural mechanism kick into gear, it is nearly impossible to stop them. You must react to an early stage because, frankly, you don't have much time. That's why prevention is important. It is critical to have trade processes and a fixed set of rules in place when trading. You need iron discipline and mental strength so that you don't fall victim to greed. Above all, keep the following guidelines in mind. Keep your distance from adopting an observer by adopting an observer rule. You are just observing what is happening in the market. Never take the losses personally. Don't take it personally. They are not personal. Single loss, you can even have drawdowns in your account, still not personal. Never identify, never identify Or keep the following guidelines in mind. Keep your distance by adopting an observer rule. Never take the losses personally. Never identify with your traits. Non-attachment. Don't identify. Your traits doesn't determine you. You are only taking risk. And mind you, the thing, what causes all these things and makes it worse is the fact that people are over risking. Yeah, you have so great expectation from this thing. We all do, and we really do. At least if you even if at all you are expecting, if your expectation is high from trading, then automatically what you need to do is to kind of like uh calculate it based on probability. That's okay. Let's assume that at least I win 30% of expecting so amount of something. We in 100 trades, I'm only expected to win 30 trades. So that one gives you, so you are permitted to lose 70. And if you divide that up, you know you are only permitted to win. You are to win three, just win three in 10. That's win three in 10. And whatever makes you to lose 10 in a row, then something is wrong somewhere. It's either you are yet to perfect your strategy or you are not following it to the goals. So take a break and move your body when you have the feeling of becoming cocky or euphoric. For now, an overview of mental self-coaching requirements, coaching techniques that might help you in managing your neural mechanisms. See chapter 6 and section. You get it. Remember, greed that is difficult to control in trading leads to a lack of discipline and points to addictive behavior. Psychological studies indicates that there may be deficit in personality development. The German Central Bank and the European Securities and Market Authority regularly warn against the consequence of excessive speculation with leverage products. The large number of individuals who are essentially addicted to playing the stock market is a cause for concern. Managing losses, uh, managing losses, another subtopic, managing losses. The trader cycle at its limits. I return time and time again in this book to the depressing topic of trading losses. After all, it is not easy to have an operation where losses are a normal part of everyday life. In other jobs, you receive a fixed salary for the work you've done. It's not easy to have an occupation where losses are a normal part of everyday life. In other job, you receive a fixed salary for the work you've done, and you may even earn a performance bonus. Imagine a situation where if your performance were poor, you would not only forfeit your paycheck, but also have to hand over money to your boss. Unthinkable, right? That's unthinkable. That's true, sha. But this is how it works on the stock exchange and forex trading. It is not simply the case that you earn money. You earn nothing if your strategies and setups don't work. What's worse is that you have to come to terms with the fact that despite all the hard work you may have done, you still have to pay out on top of that and lose money Jesus Christ. This is serious. This is a very, very mad way to think at this thing. Like you are working 9 to 5, you are earning salary. If you have a bad performance, you have to pay your boss. Ah, Jesus Christ. So this unfortunate series of events occur in half of all trades, according to statistics. That not only hurts a great deal, but also runs contrary to our evolutionary development. Human nature was not created for trading. Impending loss inevitably triggers ancient programs in your brain. If you were to follow your natural instincts in trading, your portfolio will probably be ruined in the shortest possible time. If you don't want to belong to the vast majority of private traders who, according to statistics, fail on the market in either the long term or short term, you need to learn to deal proactively with losses. More specifically, you need to build up your defenses against your own evolutionary heritage and emotional bulwark. as it were. The building blocks for such a bulwark consist of frictionless trading processes and explicit rules. Not particularly exciting, I admire, but it is only way to get a grip on your emotions, your ego, and your deep-rooted response patterns. Recognizing and limiting your portfolio risk. What is your trading nightmare? You will undoubtedly answer this way. The dreaded drawdown. A continued losing streak. Your face died here and there. We do have winning streaks too. Well, now winning streaks is more dreaded. Technical stuff. The concept of maximum drawdown is an important tool in risk management. A drawdown is a measure of risk. The maximum loss of a portfolio between the peak and the subsequent low is in a period. The peak to true metric. Imagine that you have capitalized your broker account with $50,000. Your trading strategy has been profitable and you reach a portfolio of 60,000 within a few months. Then a losing streak reduce your portfolio to 40,000. You recoup your losses and bring the portfolio back to 55 before the next losing streak. Send it to the initial level of 50,000. The maximum drawdown of the account, the highest interim loss, in other words, is $20,000. 60 minus 40. The risk level amounts to 33%. Okay. So when you suffer several trading losses in a row, it has a grave effect on your portfolio and your psyche. Many traders lose their knife, break the rules, intervene, and make unforced errors. Drawdowns are the main cause of emotional stress and anxiety, and they are also the main reason that traders give up. So when you suffer several trading losses in a row, it has a great effect on your portfolio and your psyche. Many traders lose their nerve, break the rules, intervene, and make unforced errors. Drawdowns are the main cause of emotional stress and anxiety, and they are also the main reason that traders give up. Mom, no dey give up for here oh. No matter what, even if I lose my whole account, I'll still come back. I will come back. I give myself 5 years initially to learn, and I've learned for that 5 years. The remaining 5 years, come on, now to make we are here, we dey here, eh, we dey here. So we are here, not giving up. So remember, how you deal with losing streaks determines if you become profitable at trading over the long term. Let me assure you, a losing streak in trading is as certain as an amen in church. Wow. It's certain you can't run away from losing streak. So living in denial or hoping you will be spared are not sensible strategies. Okay? The statistics are clear. Assuming that you want to achieve an average hit of 50% with your trading, that means the 5 out of 10 trades are winners and 5 are losers. Now calculate how likely it is that several losses trades will occur, one after the other. Table 4.1 show does the maths for you. Doing the maths. Number of consecutive losses trade. Probability of occurrence 2, 25%. 3 trades, 3 number of consecutive, that's 12%. 4, 6%, 6.25, and 5, 3.15. The statistics are not meant to scare you, but merely to prepare you for the fact that as an active trader, you will have to reckon with losing streaks at regular intervals, and you need to be prepared for it. If your portfolio positions are large in relation to the size of the portfolio, a series of losing streaks will ruin your annual performance. Technical stuff. A striking number of traders overestimate their hit rates. In practice, the vast majority of traders don't achieve more than 50% of win interest. By all accounts, it is not the success quota that's critical. Far more important is to know when you are in the wrong position and you are positioned correctly in order to limit your losses and expand your profits. Remember, a drawdown is not the same thing as a loss. Remember, a drawdown is not the same thing as a loss. Loss is different. Drawdown is different. The balance sheet value of the portfolio in the drawdown example earlier in this chapter did not change. You suffered no loss. So at the end of the day, you still have 50,000. The fluctuation range, however, is enormous. The risk level amounts to worrying 33%. Most of the traders underestimate the fluctuation range because they see losses only in relation to the purchase price. In addition, they underestimate the emotional roller coaster. For more on the danger of fixating on particular reference points, see chapter 11. The concept of drawdown is an important measure to determine your portfolio risk. As become clear, I hope it makes a lot of sense to pay attention to the financial mathematics. The impact of a losing streak can be illustrated using the numbers, providing much needed clarity about the opportunities and risk from higher level perspective. By focusing on financial figures, you can number one, analyze the risk of your entire portfolio, not just your individual trades. Determine the loss tolerance for your trades. Limit the effect of individual losses on your portfolio. Have an overview of the profitability of your total portfolio. We humans, we humans are by our very nature quite happy to suppress thoughts of potential losses. After all, who wants to steer into the abyss? As a consequence, most traders underestimate the risk they face rather than correctly assess such risk. Most people prefer to dream of profits opportunities. Time for some straight talk. The proportional portfolio losses you suffer as a result of a large trading loss requires a significantly higher percentage of profits with the falling trade to compensate for that loss. This is simple financial mathematics. Table 42 shows why it is extremely important to keep losses within narrow limits. Yeah, the impact of a drawdown on your portfolio. Initial loss 10%, required gain to break even is 11%. 20% is 25, 30 is 43, 40 is 67, 200 portfolio is Jesus. The effect of large losses are frightening. The required percentage profit in order to compensate for such high losses increases disproportionately. Let's be honest, how realistic is it to achieve 100% performance to make up for a 50% loss, at least without excessive additional risk? How often do I hear of traders who have destroyed their entire annual performance with a single losing streak? How many traders try to recover lost capital with aggressive leverage strategies and high stakes, and then lose everything irrevocably? Andre Costolani summarized it best. You can win, you can lose, but winning back impossible. Remember, keeping your losses small is one of the most important rules in trading. It is easier to recoup small losses than go for two shoes. Never forget that capital preservation always has top priority. Warning, your trader's hike is a major stress factor over the course of your drawdown. How long will it take to recover your losses? The psychological pressure can be enormous during this time. Surviving losing streaks. Surviving losing streaks. The law of financial mathematics are clear. You cannot avoid losing streaks. Okay, the laws of financial mathematics are clear. You cannot avoid losing streaks. The more trades you make, the more the probability of a drawdown increases. The numbers should provide anyone with a warning inklings into the abyss. But many traders have nevertheless plunged right into that abyss out of ignorance or negligence because the emotional trap snaps shut. Summoning the psychological wherewithal to survive a losing streak is a massive challenge. You will manage to maintain your emotional balance only if you have an airtight set of rules you can hold on to. Process orientation in trading is the key to success in stormies. Otherwise, you will lose your grip and control and end up growing. Tip. You can control the extent of your losses by applying the when no 1% rule. Risk only 1% of your capital per trade. By sticking to this rule, you can limit your losses during drawdown. Just keep in mind that in practice, this rule is harder to implement for smaller portfolios. Experience shows that the fluctuation range increases dramatically with decreasing portfolio size. The reason is obvious. Position sizes don't match the size of their portfolio. Beginners with the little starting capital tend to enter into a large position. Their impatience and their greed for major profits can sometimes overwhelm them. It is obviously hard to trade in small position with proportionate risk. The danger here is that you won't survive your learning curves if you trade regularly. Losing streaks are inevitable. And we are learning curves. We are forward testing. And we really want to survive. We want to survive. Remember, a drawdown can result in portfolio losses so significant that you won't even have a chance to recover from them. A drawdown can result in portfolio losses so significant that you won't even have a chance to recover from them. Financial fluctuations increase the emotional stress that may prove unbearable under certain circumstances. Your error rate increases if, in addition, you lose your emotional balance. You take the huge risk that you will ruin your portfolio in a short period of time. Studies confirm this phenomenon. A remarkably large number of traders with small portfolios suffer a total loss within a few months. Tip: calculate the historical maximum drawdown of your trading strategy. Carry out backtest on your demo accounts. You can then decide how much risk you are prepared to take and what fluctuations you are willing to accept. This is the foundation for determining position sizes and stops, and it has the added benefit of preparing you mentally for trading. If you have worked out potential scenarios in details in your strategies, you will be more prepared psychologically. After you have successfully tested your trading strategy in a simulated environment, take the following actions. Determine the maximum portfolio risk you are willing to accept. Determine the maximum position size that doesn't endanger your portfolio in case of drawdown or exceed the selected portfolio risk. Start with a few low stakes and only increase your position successfully and only if you are able to transact your trade in an emotionally stable, consistent manner. If your trade if you trade regularly, you soon discover that drawdowns are more common than people think. Be aware of the massive risk to your portfolio and your psyche. Setting effective stop loss limits. Placing a stop loss order should be done sensibly and should take into account the market environment as well as your portfolio. Among other things, many traders make the error of determining a fixed sum as their maximum loss. This is understandable but not professional. Either the amount is too large for your portfolio in case you end up in losing phase, or your stop is set too narrowly, with the consequence that you are stopped out too fast in volatile markets. It is more sensible to take into account the framework conditions of each individual trade. That means completing both the set the stop loss depending on the expected market volatility. Take your portfolio aspect into account when setting stop loss limits. so that your total portfolio is protected. Technical stuff. You can choose from a variety of techniques and variants when it comes to using stop loss or others in order to secure your position. Besides the classic price stops, you can use time-based stops, technical stops, volatility-based stops, or trailing stop loss orders, where you trade them into the profit region piece by piece. Personally, my strategy determines, I've said that before. Generally speaking, a loss should clearly signal to you that your trading strategy isn't right for the current market environment. Find out the reason for this. Doing the research here can help you resist the temptation to try to re-enter easily without thinking. So I freely admit that it requires much patience to wait for your opportunity, especially if you've been stopped out. Your ego will surely try to get involved, hoping to get your lost money back. Hold back, and trust your strategies. You should be trading only the setups with the best probability of success. If you know your opportunities and risk in the current market environment, you will be successful in your trading. Managing your position actively. Another subtopic. In my coaching practice, I stress time and time again that one should always trade according to the rules one has set for oneself and with clearly defined setups. This process orientation is the key to success because it is the only way you will have your emotions under control. Of course, you can always just sit back after entry and wait until you've reached the profit target of stop loss limit you set for yourself. When it comes to beginner, the passive implementation of setups is often best strategy. Experienced traders master the art of the active management of open positions. That doesn't mean that you break rules and intervene arbitrarily. Quite the contrary, you observe the market closely and actively search for price relevant information. You have a sixth sense to perceive and anticipate changes at an early stage. You act in a controlled and well thought out way. The market is in a constant state of evolution with new data and information arriving and being processed by market participants. The probability of gains or losses of your position changes constantly. Active position management means that you continuously keep an eye on the impact of market development on your positions and reevaluate your opportunities and risk. For example, if the market movement supports your trading strategies, you excuse me. If the market movement supports your trading system, you increase your position, trade the stock to ensure the risk, and maybe increase your profits. You know. If the market environment changes to your detriment, you may dissolve a part of your position before reaching the stop loss limits, or you can simply close the entire position early. So the decisive criterion for your active intervention in an ongoing trade is the change in probability. It makes little sense to hold a position if the prospects for profit have deteriorated. Experienced traders quickly recognize whether a trade is moving in the wrong direction and respond immediately. It can make a lot of sense to expand the position if your trading idea is on the right track. Of course, this assumes you have a firm grip on your portfolio risk. You are in a position to truly act proactively when you are quite clear about what you are right, when you are right and when you are wrong. This requires a lot of experience and excellent market knowledge. When it comes to your profitability, it's just as important to develop position management skills as it is to have the best trading strategies. Remember, you are working a narrow tightrope. With active position management, it requires a lot of experience and iron discipline. Be careful that you don't unconsciously fall into the habit of tossing aside your own set of rules. Well, we've come to the end of chapter 4, and we are moving to part 3, emotional sovereignty. So this will be the end of our video for Lead with Me today. And we're going to continue from part three tomorrow, which is emotional suffering. Thank you very much. Have a lovely and a profitable day. God bless us all.